Good afternoon, everybody, and welcome to Gary's Traders Group. It is Monday, January the 26th, a little after 4 p.m. Eastern Standard Time. This is your host, Gary Humeski. I want to welcome everybody on board, new as well as old. And like always, let's go ahead and get through the disclaimer real quick. This webinar is for educational purposes only. I'm not giving any kind of trading advice whatsoever. Okay, with that done, let's go to the long-term outlook real quick and see what's happening. Everything seems to be still in an upward slant on all indexes. We've had these pullbacks, this up, down, but we're almost at a breakout here on the Dow Jones from a negative detrending price oscillator. We've already had a breakout on the S&P as well as the NASDAQ. We have our hull pulling up on all three indices. We have a person's pivot study and a David Elliott MOBO breakout on all three studies. You can barely see that one, but it's right there and right there. So all in all, this market looks favorably to continue to go up. We see where the retracements would be, and we could see it came back and hit the 38.2 on the Dow, as well on the S&P. Didn't quite make it on the NASDAQ. But from these long-term chart perspectives, everything seems to be looking like it's still going up, even though we're in a little bit of a hesitation period, if you will, consolidation. And as you guys recall, in the beginning of the year, I said this year is going to be kind of laid with all of the ups and downs and pullbacks, but overall the long-term picture is still positive. As we know, the head of the ECB, the European Central Bank, Draghi, decided to purchase $1.12 billion worth of debt, so that was real positive news last week to pull the market up. We had some elections in Greece today. Didn't seem to do much to the market. The market still seemed to be pretty positive. Let's take a look at what the VIX looks like. Yeah, it still seems to be continuing to go down, as we can see right here. Still have a breakdown and MOBO, a breakdown in the DPO, detrending price oscillator. And when you look at that versus the SPYs, we have a person's pivot breakout, MOBO breakout, a hull pulling up, as well as a DPO pulling up as well. So again, the fear index is pulling down, the S&P is pulling up. That's a classic sign of a market continuing to go up and continuing to rally. Alrighty, and as you can see, we ended up positive today on an upswing. We had some divergence though. The Dow was down and the S&P was up. Normally that's not a good day to trade. But everything ended up pushing up positive, which is a good sign. Aftermarket is up 24 points on the Dow Mini Futures, up 8.5 on the E-minis. So it seems to continue the trend aftermarket. All right, let's take a look at what short-term says. We had durable goods that are coming out tomorrow before market. Not a biggie. But of all this week's biggie, besides jobless claims, GDP, it's Wednesday. Everybody's going to be looking to the Feds whether they're going to raise rates or not. So watch on Wednesday at 2 p.m. Again, this is a big earnings week. Got a lot of earnings to go over, as well as some seasonal directionals. So just be aware that these things are out there that will affect the market, and it could affect it quite heavily. Now, a lot of times these things are built in, and we don't see that big of a reaction, but just simply be aware. Wednesday the 28th, 2 p.m., the Feds are speaking. Okay, let me see a raise of hands. Who took Netflix trade last week? Anybody? Oh, come on. Somebody had to take it. I know one guy on this. I don't know, is Bob on here? Doesn't look like Bob's on here today. Oh, yeah, you are. Yeah, there's Robert. Robert was going to take it but backed out. Anyways, what a home run for everybody, huh? And it continues to crank, which is great. FFIV, loser. But all in all, I'm at about a 62% for all trades last week. You'll see that reflected in the Excel sheet that will be emailed to everybody after the webinar. Okay, one of the individuals on board asked me to go over a particular trade and talk about it, so I'm going to do that. And that happens to be one of our favorite traded stocks, Apple. Let's first take a look at seasonality and see what seasonality says on best choice. First of all, just looking at this chart, plain basic, good chart to look at. We have an 8 EMA crossing the 21. We have a positive MAC pulling up from being oversold. We have a strong 1, 2, 3, 4, 5 days of higher highs and higher lows. A little bit of consolidation today, but that's not untypical prior to an earnings event. So, linear regression points to stock pulling up. I think that a lot of the hedge funds have beat down Apple good enough to be able to start purchasing it, as well as I think last third quarter was beneficial to Apple on their ISIC sales as well as their China sales. So, and there's a couple of companies that provide stuff for Apple that I'm going to talk about today as well. Anybody take Skyworks, by the way? What a great home run that was last week. SKWS, that was a great trade as well. Great company. Write that down. Remember that company. SKWS, Skyworks. Fantastic company. It's going to continue to grow. It provides the computer chip for the iPhones and for Apple. It's one of the reasons it's so strong. Okay, from a seasonal perspective, Apple does not look good, but you got to know how to use best choice. When you highlight this area around those green dots, typically it's a short from about the second week in January to about the first part of February. And if you click on the various years, you can see last year, this is a strong downturn, was a negative earnings, even though, which bodes to the short. 2012, even though it shows a negative return, that's only if you bought the stock at the closing price of the 12th and sold it on the closing price of February the 3rd. Does not reflect what happened with earnings. Earnings, you can see, it missed hard. 2011, the opposite. Went strong up. Went up in 2010. 09, it went down. 08, it went up. And of course, 07, it tanked hard. And 06, it went down. So we have a mixed bag, which is reflected by the win-loss percentage. However, if you say to yourself, well, what happens in this area? And you just highlight that little area. What do I have it on? Best profit per trade? I'm sorry, let's do best rating a whole zone instead. Once again, go over the downturn here. 77% probability to go short. Between, again, about the second week in January till about what? Now. This is the 26th. This is saying about the 27th. So if I highlight this area, shows me a different statistic, doesn't it? Shows me from the end of January right on up into the second week of February, Apple goes up. Not a strong move, but you got an 88.89% probability that it goes up. So from a seasonal perspective, Apple goes up. From a technical perspective, Apple is going up, 821 crossover, MACD crossover. So let's go to my technical charts in Thinkorswim, see what they're telling us with some more indicators. The blue dotted line is a 49 EMA. The red dotted line is an 89 EMA. These two indicators I got from a guy named Bill McCready, who got it from a floor trader in New York. Awesome, awesome moving averages. When the blue is above the red, you are long. This is good stuff for long-term investors as well. And you also will find the leashing effect, like walking a dog, with Apple when you use these MAs or pretty much any chart. It'll pull away like a dog would pull away from the leash, and then you're going to pull it back to the leash. It pulls away, it pulls back, pulls away, pulls back. Now I have three well, you know what? I don't know why I don't have this showing, so let's add this. I know, I was messing around with it and seeing where I could put it other than the top chart, because I'm trying to keep my charts cleaner. But let's take a look. So the tweaked HMA, which is again a great indicator, positive. Person's pivot study, up. Mobo David Elliott breakout, up. DPO Mobo, up. 1, 2, 3, 4. 4 indicators are positive. 49 is above 89. However, yes, they do, Michael. The 49, 89 are very powerful tools. They won't necessarily change my perspective, but it's going to really give me the trend of the stock. If the 49 is above the 89, the trend of that stock is definitely going to be positive. If it's below the 89, it's definitely going to be negative. And you can, and I like to use a longer term chart of 6 months. However, guys, IV rank, we all talked about this. It's at 82%. That means in the last 252 trading days, i.e. the last year, Apple is at the 82 percentile of its historical implied volatility. It's very high, folks. So when you have something that high, one of the things that professional traders will do is sell the volatility, sell against that volatility, because inevitably this is the build-up to the earnings trade, or what's called the binary event. Binary meaning two, it's either going to go up or it's going to go down. So very typically after, especially major stocks, there's volatility crush. That IV is going to be sucked out of those current expirations that are, no matter what month you're looking at, they're all pumped up by the market makers. So keep that in mind. But if Apple does well, as long as your directional call is going to be, in other words, price moves above your directional call or what your stock is going to be, you will not receive that IV crush. If it falls below it, you will lose money on a directional trade. So you have to be careful when you're doing directional when you have IV this high. Okay? Now, as you recall, our historical move on Apple, we expected a 3.23% move. Okay. So if Apple closed at $113.10, I'm going to multiply that by what I expect the average move to be to give me a target price of $116.75. Okay? So let's compare that to what the market makers think. Market makers, MMM, market maker move, $6. Well, $6 on 113.1 plus $6.10 puts me at a target of $119.20. This is based on what they expect immediate move. Now, the third is your IV plus category, which is over here. This is, you could see the plus or minus of $9.87. This is telling you with the current implied volatility for the expiration month of February, if you held the position until close, it could go up or down $9.87. Well, we're expecting a bullish move. So if you apply that percentage, or that, if you held it, in other words, to expiration, or held it longer beyond earnings if there's a pop, the potential of it going up to $122 is there. So we're conservative, are we not? Right? We're saying that we're expecting, well, at least with best choice, it's being conservative. We're expecting this thing to go up about 3.23%, which is $116.75. Okay, we can see here 125 open interest, 19,000 bought today at the 115s for $3.15. Is that cheap or expensive? It's about 2.5% premium. In other words, $3.50 divided into 113 gives you your premium ratio, your premium to stock, how much you're paying. How much is that per share on an option on a February expiration? Saying it's $3.50 per share because it controls 100 shares, don't forget, which means you're spending $350. Again, about a 2.5% premium. We like to have cheap, 1 to 3%, thereabouts. So going back to selling the volatility, one of the things you could do, look at that, 60,000 contracts at the 115. You think those aren't some people selling the 115s? Selling that and 34,000 buying that for protection, getting a credit of $2.42. Where's your break even? Break even is at $112. So as long as this does not get down to $112.58 by expiration Friday on February, you're going to make $242 on a $5 spread between 115 and 110, which means you have to have at least $500 per contract that you're buying on that spread. It's a $5 spread. So $1,000, 2 contracts, $444 less commission. Not bad. So that's one way to sell that volatility, right? Because all of these prices are marked up. How do we know it's marked up? It says right here. Apple is at 82% percentile of its last year's total implied volatility. That means all of these options are marked up heavily. And they're all going to come down after the event tomorrow afternoon. So now, one of the more conservative credit spreads, I would say, is selling the 113s and buying the 110s for protection. I call it a tri-spread because there's a $3 spread between 113 and 110. It's $3. So that's maximum I could make, less what I paid, or what I get credited for, excuse me. So I get credited $1.35, which is what I could make on that spread. It's almost 50%, isn't it? It's about 42%, something like that. Let's see. I've got some other stuff that I'm looking at on another screen. Give me 1 second. It's a calculating strategy for a bull put spread on Apple. Yeah, you could still do the 113, 110s. It's a 71% potential profit, whereas if you did the 113, the twosies, sell that, buy that, 47-cent credit, but it's only $1 spread, folks, which means all you got to do is put up $100. $100 in your account will make this trade. But what is 47 divided into $1? It's 47% return. That's actually your highest potential credit return on a bull put spread, break even 112.53. So you could either do the 113, 110s, make $1.35. Your break even is only 111. You make $135. Or you could be a little bit more conservative Sell the 113, buy the 112s, get a 47-cent credit. Your break even is 112.53. As long as it doesn't go below that, you're going to keep that $47 for every $100 you put up. Well, that's a 47% return. Not bad. Your only risk is the $53. Very cheap, right? On a $113 stock, that's a great trade, folks. It's a really great trade. Okay, so directionally, your best long call for potential profit is buying the Feb 118s way out here. You know what, let's put this out to a 15 strike level. 172,000 contracts bought at the 120s. Wow. Well, you know what? Take a look at best choice. Where is 120 sitting on a 6-month linear regression on the high? 121, right below the top, right? The high is 121. Let's take a look at my charts. There's your fib extensions. 50% extension from the low to the high to the low puts you at 117.49. Guess what? 61.8, the magic number that Leonardo Fibonacci came up with. It actually 1.618. This is just an extension of it. It's 120.38. Wow. No wonder people are loading up at the 120s. And you have a 28 delta. Dave McMullen, who manages a $500 million hedge fund in California, owner of Best Choice Software, big believer of it, on one of his seminars said that he never makes a trade with a delta less than 20. There you go. It's 28. It's only $1.78, about a 1.2% premium. I'd be a little bit more conservative. I mean, you could go to the 118. I would simply be more conservative and probably for the highest potential return, I mean, we're talking a potential of 184% return, I would be doing the 118s for 232. Last strategy you can do on this to reduce your risk, it also reduces your profit, as a bull call spread, or what's called a debit spread. And for that, just 1 second, folks. 123, 124 is your highest potential return. $123, $124. Buy a vertical. 16 cents is all you will pay for those two. If that puppy pops up, now wait a second, I got to make sure of something here. Yeah, this is Febs. Oh, excuse me. If you're going to do spreads, and my apologies on this, you want to maximize time decay for a credit spread. So my apologies, I wasn't using the right expiration on that. For a credit spread, could you hold on 1 second, folks? Just hold on 1 second for me. I have an unruly Great Dane that needs to go do their duty. Wait a second for me. It won't be long. Okay, back. I'm sorry, once again, I was talking about if you're going to do a credit spread, take advantage of time decay. You want to be able to take that credit in and have those options expire worthless. So with that in mind, for a bull put spread, again, this is today. These things will change a little bit tomorrow based on what happens. If you don't see much of a net change, these particular strike levels will not change much. If you do see a great change, you're going to have to recalculate. But as it stands today, the same exact strike levels, sell the 113, buy the 110s for $1.23 credit applies. Your break even is 111.77. Difference is with this, folks, is if Apple pops like we anticipated to do, and another, I guess, confirmation to that would be what do the analysts think about? You have 21 analysts on a strong buy out of a total of 31. Pretty strong. Target of 125. Strong buy. So analysts are pretty positive about this as well. Gives you a little bit more confidence that people that know more than us, supposedly, are also very positive in what they expect to happen with this. I have other sites I go to verify some valuation. But so you got a nice credit to sell the vol right there, sell the volatility for a bull call spread. 120, 121 is your best buy right now. So buy a vertical 19 cents on a dollar spread. You put up $100, you have the potential to make 71% return. Difference between what you put up and that dollar, which is 71 cents. So you can see, 81 cents. My apologies, my math is bad. So it's an 81% probability return. Your maximum loss, $19. Really good risk reward there, folks. Again, I'm learning to trade a lot more conservatively. I've learned a whole bunch of stuff over the weekend that I'm applying to my trading, and I'm sharing it with you guys. Okay, so for debit spreads, 121, 120, 120, 121. For credit spreads, 113, 110 on the weeklies, unless things dramatically change tomorrow, which I don't anticipate them to do. There's no real fundamental news coming out of the government. Durable goods is not going to move the market that hard. For a directional trade, you're going to want to go to the, give yourself some more time. And I think I already picked that. I said the 118s is for $2.32. Spend $2.32. And of course, that's all your risk. You have infinite profit. Your total risk is $232. All right, that's Apple. I wanted to go over that for one of our members. Now I'm going to start ripping through a lot of earnings trades. I'm going to really quickly show you folks how I come up with all of this stuff on a weekly basis when it comes to earnings season. And most of you know this, but I'm going to go over it once again. I want to have this smaller. First thing I do is I go to FinViz. Even though they're a paid site, it's a little bit more cumbersome. I go to Screener, earnings date. Over the weekend, I do this week. If it's Saturday or Friday or Saturday, I have to do next week. So this week tells me there's 458 companies coming out with earnings, but I want to filter them out by doing average volume over 500,000. I want to filter them further out by price above $30. I want to make sure they're optionable. Leaves me 189 companies. So of those, and you know what, I could bring this up to, one of the ways you could say is, okay, out of these 189 companies, how many are below $50? So what you can do is click on price. It changes them all to the lowest, and then, of course, you click on it again, changes them to the highest. So I want to see, okay, there's 20 companies per per page. So there's 20 there. Let's go to the next one. There's another 20, so there's 40. And another 20, 60. So there's 60 companies that are under $50. So what I generally do is I'm just going to look through these. I'm going to look for companies that are familiar to me. AT&T, I take a quick look at them. ADT, these are not companies that really trade, folks. Okay? I don't care about them, right? Sure, there may be a great trade in there, but it's not what I'm looking for. I'm looking for the ones that are going to jump out. So none of these jump out to me. So I quickly move to the next page. Does anything jump out here? Well, Coach is, but I know Coach, and real quickly I'll just go to seasonal. I'll type in Coach and say, hey, what does Coach seasonally do now? I want to stack the odds in front of me. It doesn't look good, right? That's best rating a whole zone, short. That's only to the 21st. What do I have after the 21st? Well, 84% to go long, right? Well, that's not bad. Okay, but I don't like the way this chart looks. That looks ugly. That looks surely ugly. 2013, they lost their you-know-what. So I got a mixed bag. I don't like mixed bags. I want to try to stack the odds in front of me. If I feel a little bit comfortable about it, I'll say, well, what do the analysts that supposedly know more than me think about this particular stock? Are they favorable with it, or are they not favorable? I got 14 that say hold. Doesn't excite me. Okay, so that one's ruled out. I'm going to go back to my screener. Tyson Foods. I've done some research on Tyson. And I looked at Lexmark. By the way, I looked at all 189 of these for you guys this week. So you know, Oshkosh B'gosh. Looked at them, Tyco, Abbott Laboratories. I mean, these are things that we've heard. We don't necessarily trade. Let's go back to Tyson. Let's see what analysts, since we're up here, let's just see what analysts think. Five strong buy, 2 moderate buy, which translates to a strong buy with a target of 47. That I like. Okay. What does seasonally Tyson do? I can just visually see a nice pull-up on the composite. A long from the end of the month to the middle of February, 88.89, 8 out of 9 years. Not a big move. 6.11. I'm going to remember that. Where does it look like right now? Nice pull-up. MACD crossover. 821 crossover. Bouncing off the bottom. This, as you all know, is a bullish engulfing, which is very, very strong. Michael, for your edification, there that is, right? Rating below 4, yeah, that's true, but that's the rating. I don't know 100%. Remember, the rating is taking in only 3 things in consideration when it creates the rating. It's taking in the win-loss percentage. It's taking in the average profit and the number of days. The number of days usually drag down the rating. I'm looking more at win-loss percentage. Okay, it's just saying that if you kept this trade for 15 days, based on these statistics, it's not that big of a move. Okay, so that doesn't always, if it's down there at a red rating, yeah, that's going to concern me. But 3.6, no biggie. Okay, I'm going to look at where is it standing at now. Okay, right here, it's got room to grow. It's only about the 73 percentile of its historical move. I like this chart very much. Especially MACD crossover, 821 crossover, everything looks good. So let's go look at what Tyson has for, doesn't have any weeklies, But look at that, folks. I like to trade stocks at over 1,000 open interest. I like that. I like that a lot. $41.31 stock. So I expect a 6% or 6.1% move from a historical perspective. 41.31 times 1.0611 gives me a target of $43.83. Well, 42 is below 43. Market makers are saying $1.74. So we have 41.31 plus 1.74 puts me at $43 also. That's what the market makers are saying an overnight move could be. If I held it a little bit longer, it's saying over almost $3. $3 plus 41 puts me at almost 44. So there are a lot of positives about that. And so I listed it, folks, for your edification. Kind of going through the process of what I did. So Tyson is one of the ones I listed. So again, I look down, don't like any of those. Let's go here to the ones that are the last ones. And, oh, Yahoo. Right, that pops up. So does Electronic Arts. I looked at EA. Doesn't look real strong from a seasonal perspective, so I said, not interested. I don't know why EA didn't show up. Maybe it's not in my index. Maybe, what is EA? Maybe it just hasn't been traded that long. Yeah, not a lot of open interest. Doesn't excite me. I just look from my technical perspective. Well, it's got a strong movement upwards. It's got a nice pattern moving up. What do the analysts say about this thing? Well, 10 strong buy, 6 hold. Just not real excited about it from a seasonal perspective, though. Bear with me 1 second, please. Good afternoon, Gary. Hello? Hello? I'm sorry, there is no head of the household. My apologies. What did EA do seasonally? Oh, yeah, we can't tell seasonally. Well, you know what? Let's find out what it does. Let's add it to the database. EA is traded where, folks? Is that a NASDAQ company? I believe, no, EA is a 2 symbol, so it's got to be NYSE, right? It is a NASDAQ company. So we'll take that, copy it, put it here so it's got a proper name. Put it on the NASDAQ and save symbol. Now I'm going to download data. And there is a whole bunch of records, so now I have it. Great. So now I'm going to type in EA. And now I have the records on it. Well, best trading a whole zone gives me an 80% probability. Pretty nice strong move, actually, the last few years. Let's go to best profit per trade, see if there's a tighter trade in there. Same thing. I trade 80% probability trades, folks, as long as risk reward is there. 8% move. Got to have good mouse technique in order to do this fast, folks. Otherwise, it doesn't work out the way you expect it to. See, I'm at 47. I should be at 49.47. Well, it puts me at $53. 53, there's only 54 open interest. See, again, I would decline all of this because of open interest, unless I saw something on spot month. Oh, well, now we have another situation, as Sonny Decker would say. 10,000 open interest contracts bought at the 53. Isn't that interesting, folks? That's the target for best choice. You got somebody loaded up and spend $45,000 to buy the weekly expiration. They're banking a lot of bankroll. They're expecting that thing to go up. And trust me, that's one person buying that. And a whole bunch of other people came in. So, and you could also see people being more conservative at the 50. Now, what most people do is they're looking at technical. See, the last high was 50. So they're expecting EA, which comes out on the 27th, i.e. tomorrow after market. You guys can write this down. If you want, I can add it. Yes or no? Give me a yay or nay. You want me to add this or not? I just found this one. It looks actually pretty strong. Give me a yay or nay if you want me to add this. Okay. Thank you. Thank you. Thank you. Thank you. Thank you. I'm going to add this right here. I'm just going to put it. Okay. Just had to type it in on the sheet. Okay, so again, that's how I find stuff. I'm not going to belabor and keep going through this. I took the rest of these 130 approximately, because 190 minus 60, call it about 120, and I ran them through best choice. What I did is you can't export anymore, so what you have to do is highlight all of these, go one by one, and put them onto an Excel sheet, get rid of all of these, and then you can import it. It's a little bit more cumbersome, but that's what I did to come up with earnings, 126 as you see. And so I went through every single one of these seasonally to see what works. Or you could take those and run them through best choice seasonal wizard, which is what I did right here. I brought the number of years down a little bit to 4 to include any stocks that only have a 4-year history. Left the rest of these parameters the same. And then you can go to your actual season trades list and take a look at what happens January. And here's the trades. Now, an interesting one I want you to look at is CAVM. CAVM is a semiconductor. Okay. I'm going to jump here a little bit, bounce around. Found a company. Doesn't have a lot of history, so I warn you. But I love this company. NXPI. NXP. How about that, folks? No blue lines down here, right? Just rock and roll up January to Feb. If I use best profit per trade, the thing rock and rolls 4 out of 4. Let's just use best rating. Right there, beginning of the month to the end. They happen to be coming out with earnings next Wednesday, folks, which is February. This is the company that provides the chips to Apple. I don't know if I said that before or I didn't. Maybe I said another one. But this is the company that does. And what do analysts think about this thing? Whoa. They love it. 11 out of 13, strong buy. Now, this stock does have a little bit of a history of going up, down, up, down, up, down. You can see, goes down, pulls up, goes down, pulls up, goes down, pulls up. Very low IV, only at the 29%, so you couldn't even sell the vol on this thing, right? You could. I mean, there's a way you could do it. You wouldn't get that much. So let's just look at what kind of open interest and volume there is for this thing. Looks pretty good, right? Looks real good. You got a bunch of people selling $5 spread. They're selling the 75s, buying the 70s. It's a $5 spread for $1 credit. That's a deal, folks. That's a real good deal. You only spend $1 on a $79 stock. You're only risking $400. It's not bad for a $79 stock. Your break even is $74. This has to go all the way down to $74, folks, before you're going to lose any money or start losing money. And you could see that low, well, it's 70. That low, 72. I got a person's breakout. I still have a positive MOBO. I mean, this thing is, from a technical perspective, you can see there's a leashing effect. Pulls up, pulls down to the leash, pulls away, pulls down to the leash, pulls away. Could pull down, but you have an event coming up. So I like this stock, and I'm listing it. At a 13% potential move. It's huge. Market makers say $4. Call it $4. Just add, without using any of the pennies. 4 plus 79 puts me at what? $74? That's an overnight move. Holding it a little bit longer because you see it does have that history going up, down, take a pop, pull back, take a pop. You got a high linear regression of 92 using a 90% width. Best choice is 84. Sweet spots between the mid and the high, between 78 and 84. So 80, someplace in the 80s, right? Low risk. I like the 85s. I'd swing it all the way out, and because I'm buying time, and it's cheap. I mean, could you go a little bit more conservative? Yeah, the 82.5s would be more conservative. If you could get the mark, you get it under $2. You know, depending on, because it's down today, right? So if it starts pulling up tomorrow, these prices are going up. I certainly wouldn't pay $3. But a bull call, yeah, definitely would do a debit spread on this for $1.10. As long as that's below $2.25, because that's the halfway point between the 250 spread. 250 divided by 2 is $1.25. So as long as I'm paying less than $1.25, I have the potential to make 100% of my return on my money, more than 100% return on my money, right? So if I spend 110, maximum I put up is 250, right? Maximum profit is 140, and I'm only spending 110. That's a good deal, folks. Doesn't seem like a lot of profit, but guys, at the end of the day, I'm sorry, and gals, at the end of the day, it's about making money on a consistent basis, right? As one of the old cartoon characters would say, "So right, Charlie." I like both sides. You mean as a straddle, Michael, is what you're asking about? SKWS, Skyworks was an earnings trade last week. It is not the, I know either NXPI or SWKS, which is a super strong company. I mean, take a look at SWKS, folks, as well for a longer term. Take a long-term chart on this puppy. Man, that's sweet. You actually, since it popped, let's take a look at what doing a calendar on this thing would be. This is Michael where I'm showing you something new. You know, you could sell it if you bought it tomorrow against this week's and pocket that credit. It's 100% annualized premium for $1.55. Wow. Let's say, what does March cost? $8. Ouch, too much. I'm sorry, that was May. $5.50, too much. March, $3.80. Let's see what that would cost. Okay, at the money right now, well, see, this is, I hate when they do this. This is in dollar increments, this is in $5 spreads, which stinks. Yeah, at the 85, well, there's 159 contracts, but I wouldn't. So let's see what February's is. Yeah, February's is, we'd have to go to February's. February 85, ooh, 1,423 open interest. I like that. 171, 85s. So if I sold that, excuse me, I bought the March. I'm buying a calendar, so I'm buying that. I'm going to sell that. Only cost me $1.33 on an $82 stock. There's a good calendar for you, Mr. Adams. Just found it. I like it. Let's see what the spread is. What did we have? We had February 26, 43% annualized on a $3 contract versus 37. Ooh, sorry. Only $6 spread. Not that great. But from a longer term perspective, this is a great looking stock. If you wanted to buy some time, this stock continues to go up and up and up. So, I mean, coming out and buying some time, like even buying into August and selling the spot month, it's pretty expensive. I wonder what a leap is. A leap is really expensive. Yeah, that's going to be too pricey. It's $9. So, yeah, and August is too expensive. That's $6. I don't like that. So if you have cash and capital, I'd be looking at Marches and then roll it up. As this moves up, take your profits and roll it. Roll it into May. And that's another way to trade SWKS. All right. A couple other ones I want to talk about before the time runs away. I like BABA coming up. It's not a real seasonal. It's just a strong company, guys. BABA is real good. Let's see. What did I say for BABA? I got to look at my sheet on something you can't see. BABA, 150% potential return on the oh, wait a second. Yeah, the weeklies. When's BABA coming out? BABA is coming out on the 29th before market. So this Thursday before market. So you could, it's coming out before market, and it takes a pop. You could take your money off that day, or the next day because you're paying a very cheap premium. This is an expensive stock. You can see 46,000 open interest, $3.65. You got 39,000 selling the 105s, buying the 100s. Guys, that's how you could see the credit spreads. Getting $2.29. Nice hit. For 4 days, huge. So buy the 105s, sell the 100s. You could just buy these straight out, 365s. You're buying time at the 105s. You could buy the weeklies, and I'd do the 106s for $2. That's less than 1.9% premium. There's 3 potential different trades, directional. I didn't do a call, a debit spread. Let's see, what do I have for debit on this thing? Wow. You guys will love this one. I would do the 110, 111s, 17 cents. All I'm looking for is a pop, right? Spend $17 to make 83. That's an $83 or 83% potential return. In other words, it's a 400% return on your money, folks. Not bad, right? 110. Now, unless this drastically changes tomorrow, that's your most highest potential profit to make. Okay, but it's got to pop up there. We could take a look real quick if you want and see what analysts say. $20 out of 22 say strong buy. Target of 115. Wow. Wow. That's pretty awesome. So I like BABA. Also like Blackstone, BX. A lot of people don't think about it, but it's a good looking company, making money, hand over fist. You can see what they're doing on a 2-year, 175% earnings growth, real strong company. Divergence between earnings and price. If they continue to make this kind of profit, it means it's an undervalued company. You could buy it in the long term if you wanted, buying some leaps on this puppy. Sell the front month calls against it. Seasonally, 6 out of 7 years it goes up. Not a big amount, 4.84. What do I have for BX? If you're looking for quick, for a bull call on that, 37.5 on the weeklies. You're not a lot of volume in here, folks, so really watch out. But it's the highest potential profit, right? You're spending only 13 cents, so $37. It's a great return. It's 141% on your money. But be careful because of the volume. I probably wouldn't do it that far away because of the volume. You could do the 36. Let's see what 36, 37, 55 cents. It's only $1 spread. That means I'm not even able to make 100% of my money. So statistically speaking, the one I just showed you, the 37.5, is your highest potential profit. Directionally, I just do the 36 on a weekly. I'm sorry, buying time 36 on a February for only 89 cents, 2,700 contracts. Again, all this will be reflected in the Excel sheet, so you can take a look at that. Facebook is also coming out, and I think they've made some good money. I think they're increasing their sales, increasing their advertising. What do analysts say? 24 out of 30 say strong buy. So actually, buying is 28 out of 30 strong buy, target of 94. Facebook does not have a lot of history seasonally, so it's not something you can really rely on. It's 2 out of 2 at this time of the year, but you still have 2 out of 2 here. There's just two years does not make a repeating event. So statistically, nice bounce chop. Linear regression is moving up. You got a MACD just about crossed over. Look a little bit further. Nothing but making money, huh? Railroad tracks supporting price. Gotta love it. Facebook, Feb 80s. What a Feb 80s. Yeah, 9,400. Look at that, 3,700 contracts bought. I'm sorry. Feb 80s, 32,000 with 4,200. That's the one I like. 39 Delta, 201. That's a great trade right there. I like that one. And then on the selling the front, again, the reason you want to do weeklies if they're available for a debit or credit spread, you want to use time decay to your advantage. Okay? And then on a credit, you want it to expire worthless. On a debit, you want it to close above what you sold. Simple as that. And you're trying to take advantage of time. Remember, 2 games we play in this game of trading options: intrinsic value or time value. Okay? With playing the spot months, the spot expiration on an earnings trade, you are taking advantage of both. Okay? Time decay for the credit, right? Intrinsic value also with very little time on the debit spread. Okay, any stocks you want me to go over real quick? Oh yeah, shucks, and I think, Jose, you left. Jeez, oh Pete's. Or no, are you still here? Jose, are you here? Because you had Cat, VA. Okay. Cat, I don't like. They're getting beat up. They're getting beat up real bad. I don't know why. I mean, it's a great company, but look at that. Just price is getting destroyed. Earnings are going down. I don't know what's going on with this stock. I really don't. But, I just don't like that, Jose. Just that one thing alone will make me roll something out. I mean, yeah, you could say, well, that's only one indicator. True. That's very true. Analysts don't like it when I got that kind of mixed breed. 9 say hold, 2 say sell. So out of a total of 17, you got 11 that are negative on it. Mining tanking, that's true, Michael, exactly. The whole thing with fracking and all of that. So the purchase of the large equipment is killing it. So I just don't like CAT. Let's go on to what's the next one somebody asked me about. Where are you? Where are you? Where are you? Where are you? There you are, KBA. I think I had, I don't know if I had Boeing listed or not. Not a big mover. Out of 13 years. It is a mover, but not a big one, Jose. See that? Now look at that percentage move, and well, let's play the odds that are stacked in our favor. 3% move. It has got a nice pattern rolling up. Took a nice pop today. sitting at, what is it, closed at $134. Not real strong seasonally. I mean, you do have an 84% probability, so let's see what kind of open interest we got on this thing. Got a lot of people loading up at the Feb 135, 7,900 open. You got some credit selling the 135, 130s. You see how it's loading up between those two strikes. So $2.15 credit. Break even is 132. You just got to go down to 132 before you start losing money. And that's buying time, folks. So you're assuming that it's going to continue to go up, and they hit on all three cylinders. You got some debit spreads here. You can see that where people are loading up 7,900, 4,300 for $1.53, $5 spread. You got a nice strong potential, $347 return on a $153 investment, good risk reward, assuming it moves directionally in your direction. Market makers are assuming a $6 move by end of expiration. $6 puts you at 140, so that's right at that top strike level, right? $6.60. So it puts you at $140.67. It's kind of pushing it. Market makers are only saying $3.14 pop on earnings, up or down. $3 puts you at 137. Okay, so if you're going to pay spot month, do the 135s. What's IV on this? IV's low. It's only at the 38th percentile of its entire year history, so it's not bad. Got some good positive indicators on all of this. So not bad looking. Not bad looking. I may take a flyer on it if I was to go inexpensive. You know, I like that debit spread a lot. I mean, you could go directionally on a Feb, get as much, you know, for $2.12, that's getting the NAT, and which is, let's be honest, that's the realistic price you're going to pay. Okay, you could go out to the 137s, $3 plus 134 puts you at 137. I think our move seasonally, $3, 3.17, 3.17. Puts you at 138. So if you're going to go seasonally, I'd look at the 137s. That's cheap premium. It's less than 1% premium. And you still got a decent delta at 32. I would not stretch it to the 140s. So BA is not bad. Facebook I went over, Jose. Qualcomm, Amazon. I think I looked at Amazon. Something about it. I don't know why I didn't list it, but it may be one I missed. That's why we do these things. Oh, yeah, that's, I think, what I looked at. Didn't look good from a seasonal perspective. Last year it tanked hard. Year before that it tanked hard. Year before that it tanked hard. Went down. Well, actually, this is a pop-up. It actually went up that year. So, you know, on these dates, now I don't know, when is Amazon coming out? I guess I'd have to look at that too. It's coming out before or after market on Thursday. So let's see how this thing rock and rolls. If I did best profit, let me first make sure I've got accurate data. Well, I like you, Jose. You always come up with good stuff. An 89% probability, 8 out of 9 years. What do the analysts think about Amazon? Well, mixed bag. I got 17 say buy out of 29 total analysts, 368 target. So I got more of a propensity to go strong long than it is short. I don't see that much 310s, 300s, 310s. There's a disparity between the 310s and 300s, which tells me that's not all credit spreads. That's somebody directionally buying on a short. Got a bunch of credit spreads between these levels, 125 or 325, 320. You see that's where people are loading up. You also have a big spread between 320, 310 and 320. Right? That's where you got open interest. That's how you can tell that people are buying debit spreads. But this is, real simple. I know why I looked at this, but I ruled it out for everybody. Jose, what do you know about me? I'm cheap. I mean cheap for the sense of I like to buy cheap options. This is expensive premium. And if you felt strong about it and you had $1,000 per contract, still, I mean, this is over 100% probability return. You spend $436, you could make $564, so you could make more than what you spend, break even at 314. That's still a lot of money to spend on one contract. And I wouldn't go super far out of the money on this. So even trading the weeklies, it's very expensive premium. That's what turned me off, Jose. I mean, everything else looks good, but it's just too expensive for me. CVX is good. I looked at the oil stocks. There's a bunch of them, CVX, Marathon, and everything else. I'd wait till after earnings. CVX is part of the oil, and I believe oil is still going to continue to go down, folks. What did it do today? CL was down 51. So a barrel of oil cost $45.06, down 51 cents. So I believe oil is still going to continue to go down. As I said before, I think it's a contrived plan by OPEC to drive the price down, get rid of the fracking in the U.S. so we become more dependent, back on the oil breast, as I call it. You know, we got to get our breast oil from OPEC. That's what they want. They don't want us to be unreliant on them, so they're purposely driving it down. This, I believe, and a lot of analysts say the same thing, we're looking at $40. I still believe it's going to go down, so I'm concerned about playing oil long. Oil historically is that good, you know, long from March into May. You know, I mean, that's a real strong move. So let's see where this thing ends up at. But right now, you got still a strong downtrend. You know, runs up, runs down, runs up, runs down, runs up, runs down, runs up, but the trend is still strong down. Let's take a look at my charts. Yeah, 49 below the 89. Jose, put those on your toss charts. And when you see this crossover, text me, call me, whatever. Tell me about it, because that'll be the time to start looking at oil. Be it CVX or COP, all the same stuff. Wait for that 49 to start crossing over. That'll be the time to start buying oil. What is, last one I'm going to talk about is Visa. It's coming out this week too. Okay, these are the extension probabilities. Visa is a strong company. Analysts, I think, like it, as I recall. Yeah, 17 strong buy. So 20 out of 24 say stay buy. Strong buy, 270. Seasonal perspective, Visa is a real nice looking pop. 6 out of 6. So, yeah, Jerry, MA. But you know what's crazy about that? MA is coming out. Visa's coming out after market this Thursday. Okay. MasterCard is coming out before market on Friday, so we don't know what's going to happen. I mean, usually if you pop C1 pop, then you can kind of rely and say, oh, okay. But I believe Visa is going to do well. From a seasonal perspective, it really looks strong. I think I also looked at what open interest was on Visa, and I've got that down as well. I mean, if you look at seasonal, what you expect to pop at 9.64%. $256.53, 1.0. What was it? 964. $964. 281. So 275. What did I put down on my sheet, my spreadsheet? I had, oh wow, I had 265 for $3.85. The heck? 265. No, that's what I had. Yeah, I had the 265s. 1,500. I didn't stretch that far out. Let me take a look at one thing real quick. And again, this stuff that I'm going to show you could change based on what happens with the price of Visa. Again, I'm going to do it just a directional and see what is the highest potential profit based on just a February expiration directional, buying a long call. And for the highest potential profit of 159%, it's the 260s. Feb 260s, from taking 1,001 different concepts into consideration: open interest, volume, Greeks, blah, blah, blah. 141% probability for the 265s. I'll stick to my guns, 265. For, you know, if it goes down a little bit more tomorrow. You know, by the way, that's another thing to look for, folks. I mean, if you think about SWKS as an example, you know, look for this kind of stuff before earnings. You know, and you got a lot of buying coming in before earnings. Then all of a sudden earnings comes and this thing just shoots off. Same thing like Netflix, right? Last week, here was earnings, right? But there was buying the day before and the day of. You want to see that kind of stuff. Normally, I put volume on here so I can also see volume. It's very important, everybody. Volume always precedes price. Remember that. Volume always precedes. You could put volume here if you want as a separate graph. You could say show volume. Make sure it's not overlap. And it'll show you the volume. I generally like to have the appearance be the same as so there you go. You see that right there, that huge amount of volume? Even though it was negative, it just shot it up. Let's see SWKS. Same thing. Look at that. Volume coming up. So you can do it as a subgraph. I generally prefer to overlay it on my main chart. It allows me to be able to see this indicator better. And you can see where there's volume coming up. See, negative volume, volume precedes price. Price collapsed, especially when price is coming down. It was negative. There was a sell-off that day, and then it meandered sideways, and volume picked up. Now, another one of these that you can put on, there's a bunch of indicators. One of them I do like just so you guys know, one of the things I use as an indicator, and I believe everybody should have this on their Thinkorswim platform. It's not an indicator that is not available to everybody. Volume average. And it puts a 20. I generally like to change that to a 50. So there's the 50-day moving average. When volume spikes above that, you know that something's going on. Okay? So that's why I have the 50. See how this popped above the 50? Boy, things just collapsed after that. This popped way, way above the 50. Very strong. That's also when it bottomed out and was at the bottom end of linear regression. Took off. So I like that volume average study that you can add on. The other one, of course, folks, that you know that I really like a lot, and I always have this because this is part of Thinkorswim's analysis, which is great tools. You need to use the tools that are available. Probability of expiration cone. It gives you an idea based on probabilities where the price of the underlying security could be at expiration. So 89.74, let's look at Apple as an example. 124.68 on February potentially. If it's positive, it could be 101. And this is the probability based on volume, volatility, expiration in Greek. So this is important, right? We were looking at the 120s. Remember, that's where everybody was loading up. For Apple, 172,000 contracts at the Feb 120s. You know, and if you're using these charting tools, that gives you a lot of confidence. 61.8 is 120, and it's saying expiration code. So that's another thing I like. Okay, options get more expensive if you wait too long and run up in price. Yes, that's true. I mean, everything that you're seeing here is based on the security moving in the direction we expect and exceeding the strike price that we're choosing on a directional long call or a debit spread, or for that matter, a credit spread. So I listed MA, Jerry, just so you know. Facebook, MA. I talked about Tyson, NXPI. Oh, a couple of ones that I'm going to mention just from a directional standpoint. And I don't know about this. You know, the whole solar industry, FSLR, you know, I mean, it's a seasonal strong pull-up, right? Some real nice moves historically. It's sitting way at the bottom of its historic. It's just been beat down so hard. You know, it's almost at the lowest it's ever been on its entire history from a seasonal perspective, and historically pulls up 7 out of 8 years. You know, but I just don't like this chart. Now that's real positive. That broke linear regression, closed above linear regression. I'll bet you that created a breakout on the MOBO. Yep. Let's see what happens. You got earnings coming out the end of February. So keep your eye on this for solar because it is a seasonal. Last one, I think from a seasonal perspective, what did I put down? Oh, I don't know about this, guys. Be careful. It's one heck of a company. Zynga. I got no history on it seasonally other than that. 3 out of 3 years, that thing rock and rolls up. Popped above linear regression. I got a MACD pulling up. I got a 89 or an 8 EMA coming up close to the 21. Hasn't crossed yet. I believe that Zynga does have a lot of excitement about it. People like to trade it a lot. A lot of open interest up there, folks. Here's the problem I have with Zynga, and I'm going to share this with everybody. I would not buy the option. I'd simply buy the stock. It's $2.67 security. Okay? So buy some time if you want. But from a seasonal perspective, this thing has some tremendous probabilities. Run this thing up right into the beginning of March. $2.23, $1.33, $3.37. So, and it's sitting right about there. All right. So, any other questions I can answer for you guys today? Otherwise, this thing is going to take a long time to render. It's almost 5:30. Good session. I hope this was helpful. Thanks, Jose and Leon and Tom and everybody else for being on board and being loyal. I certainly appreciate it. Hope you guys are learning. By the way, I'm going to stay away from selling stranglers or selling iron condors for now until I learn more about how they react with volatility and price movement. Until I get a good grasp on it, I'm not going to talk about selling strangles because you have a total undefined risk. Iron condors are a defined risk. However, the security cannot move strongly in one direction or the other because one leg is going to go too far out and destroy any profits the other one is doing. So right now I'm going to stick to long calls, short puts if it's going to be directionally short, or the debit spreads or credit spreads. For long direction, or we do talk about shorts, but most of you guys don't short the market. So that's what I'm going to stick to until I learn more about it. All right. All right. What TYVM? I never even heard of TYVM, Michael. Unless that's an acronym for something. Oh gosh, see, you're ahead of the game beyond me. Thank you very much. I didn't know that. All I know is LOL. All right, guys, till next time, great trading, and we'll talk to you guys next week.